Okay, stocks end the day mixed. Even. Down, S&P up, NASDAQ and Russell down. Renita Young, Kevin Green back with me here to go through some of the moves. We talked a little bit about the Micron story with Jeff just now, Renita, but I feel like it deserves a mention in our recap today, given that it was one of the key tech stocks dragging lower on the day.
Yes, it's dragging essentially on these latest U.S.-China tensions. It's really gotten caught up in that. So has the entire tech sector today. And it's on news that the White House has asked South Korea to encourage two of the top DRAM memory chip makers to not sell to China if it chooses to ban Micron from selling there. Now, back in April, China launched a national security review into Micron. And because of the timing, many people viewed that investigation as retaliation on the U.S. for its efforts to take out Chinese competition in the chip making spaces and in the telecom spaces. But Micron is one of the three dominant players in the global DRAM memory chip market. And if China bans Micron, it can make a substantial impact on its bottom line, because just in 2022, Micron made 25% of its revenue from mainland China and Hong Kong. Chip makers have already been under pressure from this glut in the industry that's caused in the last quarter of this year, in the first quarter, I should say, it caused about a 25% drop in prices. So it's already a market that's been hammered pretty badly, and something like this could do a little bit worse, Oliver.
Okay. The chip makers were able to kind of navigate this storm, only dropped 0.5% on the day, but they've been such a key part of this rally, Kevin, that we don't want to see them break if we're bullish. Have they broken it all? Because you and I talked about this group really consistently for, I don't know, like 2 months basically, right? March and April, the run up in the SMH to 265, the potential breakout that now is kind of floundering. What do we make of this?
Yeah, right now we can't say that it's failed at this point in time. We might say it's a little bit of a breather from that run-up that we have seen, but that run-up has also been very concentrated in a couple of names here, Oliver. You want to see a little bit more of a broad-based rally when it comes to the semiconductor space. So from a technical standpoint, until we see it drop about 5 to maybe 6% off of those highs, that's when we would say, okay, it may have actually failed. But right now, this is just a little bit of a setback. And I think rightfully so, as we're getting into earnings season, it's going to definitely provide a lot of volatility across all sectors, and we want to be able to, be able to comprehend and understand the data that's coming out, and then be able to make a judgment on how to move forward here. I think there's a couple of names that have definitely taken the spotlight. NVIDIA, with the AI type of boom here, we see analyst adjustments pretty much almost every single day about how bullish they are about this future vision of AI, and that's been their base. But a lot of the other companies like Intel or even AMD just haven't been able to catch that bid yet. They just don't have the technology yet to be able to capture that space. So I think right now it's just a little bit of a breather. If we continue to see a move to the downside here, then I would be a little bit more concerned. If we also do see Micron being blocked from selling chips in China, I think that could really rock the boat here, Oliver. That could actually create a catalyst for, not only just from a chip space, but also from a technology space, communication space, and that could really rock the markets. I'm not sure if we're there yet, though.
Okay. Yeah, after all, NVIDIA a little changed. It can't be too dramatic when the leader here is basically unch at this point. All right, let's talk some earnings, as we do have a couple names that are worth getting into this afternoon. We've got First Republic Bank and we've got Whirlpool. So look at the banks and then look at the housing connected stocks here. There's a beat on the bottom line for FRC, 123 versus the 85-cent estimate, and the top line also came ahead of expectations by about 50 million here, 1.2 billion versus 1.15 expected. Non-interest income, just shy of $1 billion on a net basis, 923 million. Sorry, that's net interest income, and then the non-interest income roughly around 300 million. What's going to be important here is going to be deposits to see if there is any major bleed from this company relative to expectations. Their net interest income did drop lower by about 20% on an annual basis. That's probably not going to be it might be a concern, but that's kind of more relative to what we've seen from other banks, Renita, where a lot of the strength we saw in banks were those that were able to surprise to the upside on their interest income and show their net interest margins paying off. That's not the case here, so that's going to hurt a little bit, I think.
It might hurt a little bit. And so, but when you look at earnings, though, the fact that it beat by a pretty large measure, there were some estimates as low as 72 cents. And so earnings per share came in at $1.23, just as you said. And so this might be an effect of what analysts were saying earlier about how First Republic could be one of the beneficiaries of the downfalls of the other two regional banks that happened. And so it's got
in theory. I'm not sure it's going to happen, though. Sorry to jump in. They just said that they're calling their quarter unprecedented deposit outflows. Stock just got hammered.
Okay, we see that happening right now.
Not bad, though. Only down 2% from year-end for their total deposits. That's not that bad.
That's not that bad. I mean, but you can see how cloudy this picture is and just how difficult it might be for one person to look at the expectations going even forward more into the next quarter, right? So I think it's going to be a mixed bag as we see more of the results coming out for certain.
Okay. You know, it seems like it would be a little bit, the market might be a little bit more welcoming to that figure on deposits if their net interest income didn't decline 20%. Deposits were down 2% from a year ago, net interest income down 20%. I mean, it's, to Renita's point, cloudy at best here, Kevin.
I wouldn't even go that far here, Oliver. I think these results are really bad,
really?
unfortunately.
Okay.
Yeah, and I hate saying that. Here's the reason why. If you look at total loans right now, it's at 173 billion at this point in time. Total deposits, 104 billion. So before this happened in December of last year, they reported that they had 92% of their deposits covering loans. Okay, if you look at the loan profile right now, it does appear from when the numbers that I'm looking at that it's roughly around potentially maybe even half, less than half. And then that's actually very significant. That's an issue, which is another reason why we're probably seeing the stock drop pretty significantly. That means that they're not really well capitalized at this point in time. On the call, they're probably going to have to talk about ways of them being able to adjust this positioning here. Yes, the cost of net interest margin or net interest income at this point in time has definitely hurt them. I actually looked at their rates before coming onto the show here today, and they are actually fairly lower than the streets, what the streets going for. That's not how you're going to attract deposits, and their deposit base, unfortunately, is really centered around business and commercial lending, or business and commercial businesses, if you will. So I think right now, when you're looking at the total loans to deposits, I am a little bit concerned about that. I would be a little bit concerned, and I think they're going to have to tell a story here on how they're going to be able to manage and get out of this. I'm actually kind of surprised if they were going to report something like this. I would be surprised that some of the other bigger banks like JP Morgan, Wells, those other ones that kind of jumped in and helped them out probably didn't do a little bit more, but maybe they didn't also want to create a scare for the street as well. So that's my 2 cents when I look at this earnings announcement at this point in time compared to what they reported in December of last year.
I see. So even with their loan numbers still increasing on an annual basis, year-over-year loans up 23%, you're saying relative to deposits and what some of those unrealized losses, it still is not a great ratio?
Yeah. So, all right. So I'll make it really, really simple, right,
Okay.
Oliver? So if you gave me more credit, but I had less money to capitalize on that credit, that's probably not a good trade-off, right? I mean, at the end of the day, you want to be able to also have capital to be able to utilize within the marketplace. And right now, they have a lack of capital, and they continue to originate loans. And the problem that they're also going to have, and I'm not trying to be a super bear on this, but the concentration of where their loans are being originated from is also going to be a concern from a valuation standpoint. A significant amount is actually concentrated in San Francisco, Los Angeles, and then also in New York from a commercial real estate standpoint. Those are all three areas. Los Angeles not as much, but San Francisco and New York has seen a little bit of headwind. So when you look at the loan to value of a lot of these loans that they have originated, the actual asset values themselves have definitely declined, and they're not really marking that. You can't really mark assets on a quarterly basis on the loans that you have outstanding. So that's the concern that I would have. You have less money to be able to capitalize or shore up the loans that you are giving out. And that's not a good recipe.
That's the problem. Yeah, that's the risk point for sure.
Right. Exactly.
Also, the original figures they gave for deposits, there's a little bit of a conflicting timeline that they're giving, because the first report said they were only down 1.8%, but from the year end, but the year over year they're down 35.5%.
Right.
And so I would say ignore that first one, because then there's another conflicting report compared to the end of last year. So I'm not sure what that first number is. Deposits are definitely way down.
Absolutely. So that's what I was looking at. To be down more than $104 billion is substantial within one quarter. Down, it is, of course, it's down year over year into that measure, but it's substantial. Then also it's worth noting that the company announced it's becoming more efficient, trying to make layoffs during the second quarter of this year of between, I believe, somewhere in the realm of 20 to 25% of its workforce. So this company, as you can see, is not being rewarded for that, because it's got so many different measures that are happening today that investors are looking at, of course, as to why this stock is falling so far from it was up about 12% today, and now it's fallen more than 10. So this is all playing into this, and geez, interesting to see what kind of price target cuts will come tomorrow.
I think they're coming. The fact that they are saying they're going to have to also explore strategic options, that a combo with somebody else, what might that be, Kevin Grant?
That would probably be more of a takeout target, honestly, instead of a merger here, Oliver. Yeah, because I just had the number here. Their book value that they had, I just had it up. Their book value still said it was in the 70s, if I'm not mistaken, 60s or 70s. The stock is trading at $16. So let's look at it from a valuation standpoint. If you do believe that book value, and you are a financial institution looking to grow your book, and you have cash on hand, and you can take out a target, let's not say at $16, but say you take it out at a little bit of a higher price, and that book value is actually correct, and then you would actually have a pretty substantial gain if you were able to provide confidence into the marketplace, right? So you'll be able to buy it low, and then if that tangible book value itself is even in the 60s, and you bought it, say, at 20, that's a 4 times return on your investment, theoretically, if those asset values are true. Obviously, once again, book value, intangible value is really hard to be able to mark on a quarter-to-quarter basis, so we can't really give it that much credit. But yes, they do say that their book value is at $76.97. So if you're looking at this right now, it's trading at a steep discount to its book. Usually a bank will trade maybe down to 70 cents to par, and that would be in like the great financial crisis. You have Bank of America right now is trading a little less than $1 per share when it comes to tangible book, and that's not uncommon. Usually banks don't really trade with a lot of premium. It may trade with a 5% or maybe even a 10% premium depending on the business, but you're talking about a steep discount compared to what they're reporting as their book value per share. I would say this would be more of somebody coming in, stepping in, and actually taking the assets over rather than merging. They have really no power to merge.
Right. No, that makes sense.
What power do they have? Right, they have no leverage.
Yeah, and stock's going down too. So, all right, not a great look, but we kind of knew this was the remaining risk point for this sector. Thanks for that deep dive there, Kevin. Let's talk some. Let's brighten up the picture. Yeah. Let's clean our clothes. Let's do some laundry. And let's wash some dishes here. Whirlpool is out. Shares are up. Seems like they're revising their outlook in a positive way, Renita.
They are. So Whirlpool sees adjusted earnings per share of $2.66. That was above the expectation. Revenues were also higher. And you know why? I would guess why. I would guess that it's because of the positive sentiment in the housing market.
Sure.
And the fact that you buy a new house, you want to put appliances into it. And so it was a very good surprise to the upside, by the way, or not just to the upside, but earnings were expected to be less than they were last quarter and less than they were a year ago, even though we were still expected to be higher. So this is, in some way, a surprise. Now, the company did report the last quarter a net loss and a 15% decline in sales. That was because of the company's divestiture of its European assets. It does not have that to compare itself to now. So, or to compare or to tie into this quarter, I should say. So that's another win that the company was able to, pass off to this quarter, I should say.
Okay.
But the company is raising its outlook on some of the key numbers. And I mean, it just looks like it might be good. So we'll find out just how far this travels, you know, especially into the end of the year.
Fits in with everything we've heard from housing. Pretty positive move in all those stocks, and you know, rates come down, people spring on the houses that are available. We will get new home sales this week. We'll see how that fits into it. And the market also has been fairly positive towards some of the more industrial style durable goods names, even though this is consumer discretionary stock, a durable good at the end of the day.
Yeah.
And we'll get an update on those economic figures. So a good one here to kind of set the stage for the economy this week, I think. Good stuff, Renita Young, Kevin Green. Thanks a lot, guys. Nice work here on earnings.